Welcome to the IMFG Quarterly Market Update. I'm Scott Douglas from IMFG, and today I have here with me Dr. Steve Garth. Steve is our chair of the investment committee, and Steve's going to share with us some insights into what's been going on in these volatile times. What have we actually been seeing in the Australian market to start with over the last quarter?
Yeah, well, this won't surprise anyone, Scott. It's going to be a lot of red on the screen in this quarter. Starting with the Australian market, you can see that we're down by minus 11.9% in the quarter. And in fact, the financial year return is negative too. Now, that's not as uncommon as the media might have you believe, but it is a negative financial year.
And so what about global markets? How have they been impacted?
Yeah, let's have a quick look at that, Scott. So as mentioned, Australia down 11.9%. The rest of the world, or the world market, not as bad. It's down minus 8.4%. And the emerging markets, surprisingly, are down by minus 3.3%.
Big tech stocks have been hit the hardest. So that's had a huge impact on the market and that particular sector. Yeah,
that's right, Scott. We'll quickly look at the US, because we do hear about this in the media all the time. The S&P 500, that's been down as much as 20% in the first half of the year, and that's what they call a bear market. If you're hearing the word bear market, it's when it's more than 20%. And the high-tech stocks, which we've got here represented by the FANGs, Facebook, Apple, Netflix, Google, and a bunch of others, that's been down as much as 30% in the half year, and you can see it's down by minus 25% in the quarter. Now, these big tech stocks, they've had very high PEs, or they're very growth-orientated stocks. They've come off the hardest, and that's meant, Scott, that there's been a strong value premium around the world. So value stocks have done much better than these growth stocks, and of course that's helped the IMFG portfolios enormously, because they all tilt towards value stocks.
What's been going on in the bond markets?
Yeah, well, of course, there's been a world of pain in the bond markets. In the first quarter, people were really shocked when the market came off so much, particularly in a defensive asset. It's unusual. It has happened before in '94, but it's certainly unusual to see the bond market fall over that much. That's got to do not with rising interest rates so much as the rising yields, which are a consequence of expectations around inflation, and then interest rates tend to follow. So in this chart, Scott, you can see the quarter by quarter returns of the Australian bond market, and you can see that this quarter, not as bad as last quarter. But the other thing to take out of this, Scott, when I show you the yield on the top of that chart, you can see how that's turned the corner. And a lot of commentators are saying that bonds may have reached the peak of the pain and are now actually coming back. Certainly the returns are positive in the last month. And bonds starting to perform their typical function of being a ballast in the falling equity markets. The bonds are starting to go up again. So there's been some pain there, but that pain has probably passed.
So, Steve, what should IMFG investors expect to see going forward, and is there anything they should do or change?
Yeah, Scott, look, first of all, even though we've got some confidence that the bond market is probably settled, I can't tell you what's going to happen in the equity market. I don't know whether it's going to keep falling down, or in fact whether we've already bottomed out as well there. But one thing we do know, Scott, is that markets recover quite quickly from market downturns. In the chart I've got up here, you can see that after a 10% downturn, then stocks have recovered fully after a year, and then do better after 3 years, and even better after 5 years. And in fact, we see the same behavior even when the markets have had a 20% downturn, and even in a 30% downturn, on average, markets are recovering. So what that tells us is that markets recover fairly quickly, and so what we should do is just be disciplined, stay in the portfolio that's been set for you by your advisor, and you'll ride it out, and you will see those positive returns come back.
Thanks, Steve. So the main thing is to stick to your plan, stay well diversified, and the portfolios, we believe, are well positioned to weather the ups and downs in the next 1, 3, 5 years. Thanks again, and we look forward to hearing from you, Steve, in the next quarter.
Yeah, thanks, Scott.